In October of 2008, the stock price of German automaker Volkswagen surged 400%, briefly making it the most valuable company on the planet. But it's the lead up and fallout which make it one of the most insane financial events in history.
It's panic among investors. Many had bet on VW's share price to fall.
They claim Porsche secretly cornered the market in Volkswagen shares.
In September 2005, Porsche AG began acquiring shares in Volkswagen, and by March 2007, they controlled 31% of the company. In October, a 50-year-old corporate ownership law is changed, opening the door for Porsche to potentially take complete control of Volkswagen. Despite the rumors, Porsche adamantly denies any plans for a takeover attempt. The following year, in 2008, a number of hedge funds placed trades that bet on the decline of VW stock. Notably, David Einhorn's Greenlight Capital takes a relatively small short position, believing the stock is overvalued relative to other automakers. Other funds were also betting on VW's decline, but as a part of an arbitrage strategy that's generally considered low risk. However, Volkswagen stock continues to rise, and on October 17th, analyst Mark Warburton publishes his theory for why. He suspects that Porsche has in fact acquired a near-controlling stake in VW, and is using a loophole in German financial regulations to do it secretly without disclosure. Porsche responded to the claim, calling his thesis, quote, complete bullshit. 9 days later, on the 26th of October, Porsche released a statement, revealing they now had effective ownership of 74.1% of the shares. Short sellers were blindsided, and when markets opened the next day, it was complete pandemonium.
This share climbed over 90% today. The car maker rose 147%. The share nearly doubled this morning. It reached a level of 1,005 euro. It must be the worst case scenario short squeeze.
David Einhorn and the other funds who were betting on a decline lost more than $30 billion. So naturally, this timeline of events raises so many questions about how this short squeeze really happened, and whether or not this was an orchestrated fraud by one of the most prestigious automotive brands in the world.
Porsche is being sued by short sellers in Volkswagen stock. They claim Porsche secretly cornered the market in Volkswagen shares.
Porsche denied it was planning to acquire Volkswagen while using manipulative trades to hide its stock positions.
One of the key pieces to this story is understanding why hedge funds were betting on Volkswagen declining, because most of them actually weren't. What they were doing was something called capital structure arbitrage. I'm going to show you how this works by using my Investing Pro subscription. Quick thanks to investing.com for sponsoring this part of the video. Volkswagen has two different classes of shares, the ones that come with voting power, VOW, and the ones without voting power, VOW3. If you go to charts, you can compare stocks by any metric you could possibly imagine, but for this we just need to compare prices. Since both VOW and VOW3 represent ownership in the same company, they're usually priced around the same, but occasionally their prices do diverge. So a hedge fund could buy the cheaper one and short sell the more expensive one, and they'll profit as the prices converge again. That's a capital structure arbitrage, and we'll see why that's important a bit later in the story. This extensive charts feature is of course just one of the many incredibly useful tools in Investing Pro, backed by the best real-time data in financial markets. You can browse the Ideas tab for seeing notable investor trades the second they're reported, stock screeners, pro picks, and Warren AI, the ChatGPT of investing that will save you a ton of time. Investing.com is currently running their flash sale with up to 55% off, combined with code Hamish for a ridiculous 70% off at the moment. So take your portfolio to the next level and try Investing Pro by clicking the link in the description below. I don't want to bore you with a long history of German automakers, and, well, to avoid being demonetized, but there is a tiny bit of regulatory stuff that's crucial to the story. In 1960, Germany instituted the Volkswagen Law. It said that if a shareholder wanted to have complete control over a company's cash flows and management, then they needed to own at least 80% of the company's voting shares. At the time of this law, and still to this day, 20.1% of Volkswagen shares are controlled by the German state of Lower Saxony. So in 1960, when this 80% threshold was put in place, it was effectively preventing anyone from taking complete control of VW. And so the state had the power to stop a foreign buyer from coming in and closing down factories or gutting the workforce, for example. Fast forward to 2007, and the European Court of Justice overturned this law, ruling that the 80% threshold was illegal. It reverted the threshold to 75%, meaning a takeover of Volkswagen was now theoretically possible. Porsche AG seemed like it might be up for the task. However, management consistently denied they were aiming for full control. When their stake had reached 20%, their reasoning was to, quote, lessen the possibility that VW would be subject to a hostile takeover. Volkswagen was manufacturing the cars that Porsche designed, so protecting their industrial partner made sense. A few months later, Porsche stated there are currently no plans whatsoever of increasing the VW stake beyond 20%. Less than a year later, they owned 29%. 29% is enough for Porsche. We don't want to acquire more than 50%, the Porsche CEO stated. When they crossed the 30% mark, Porsche was required by German law to make a takeover bid for the company. But they tossed out a lowball offer, again reaffirming their lack of interest in taking control. All this denial is a critical piece of the puzzle because it lulled hedge funds into a false sense of security, leading many to make a very costly mistake. As 2008 rolled around, Volkswagen began to look like the perfect candidate for a capital structure arbitrage, just like I explained earlier in the video. The prices of the two types of VW stock were diverging. The non-voting preferred shares were reflecting the tough economic conditions, a cyclical automotive company in the middle of a historic recession, while the ordinary voting shares were rising because of the buying pressure of Porsche. Since Porsche had made it clear that no takeover was happening, the price divergence should be temporary, and so a trade could be set up to profit as it converges again. Hedge funds began buying up the non-voting preferred shares and short selling the ordinary shares. Short selling means the hedge funds borrowed the shares from someone else and sold them immediately. Then, if the price drops, they can buy the shares back at a lower price than they sold and return the shares to the lender. The opposite of a normal trade. You sell first and buy later. The trade was incredibly popular by August 2008. Quote, preference shares were trading at 100 euros per share, but the ordinary shares were twice the price at 200 euros. According to one hedge fund, nearly everyone and their brother were short the ordinary stock and long the preferred stock in what some viewed as a riskless trade. But it was anything but riskless, because the trade hinged on one very fundamental assumption, that if worst came to worst, they could just close their short positions by buying the voting shares and returning them to the lender. Hedge funds believed this because they thought the market for VW shares looked like this. 20.1% of the shares held by the state, so those are not being traded. About 30% were owned by Porsche, also not being traded, but that left about 50% of the shares available in free float. Free float is basically how many shares could be traded publicly. It's a really important number for short sellers because if shit hits the fan and they need to close their trade, there has to be shares out there that they can buy. On September 17th, Porsche increased its stake to 35%, but that still left a huge amount of shares available in free float, so hedge funds continued piling into the arbitrage trade. To Porsche's credit, they had been making some disclosures. They indicated their intention to go above 50% ownership in that September filing. However, Porsche's civil and criminal charges didn't arise out of what they chose to disclose. That had everything to do with what they were secretly doing behind the curtains. Porsche wanted to own 75% of the voting shares, and of course the full control of Volkswagen that came with it. They wanted to do it as quietly as possible so that the cost would be as low as possible. However, German trading regulations required Porsche to publicly disclose their ownership every time it reached a new threshold. So to avoid disclosure, Porsche would need to find a way to accumulate voting shares without actually owning them. Let me introduce the cash-settled options loophole. Effectively, a bank would buy the VW shares on behalf of Porsche and pay out the profits from the option in cash if the price rose. This does three very important things. Firstly, it allowed Porsche to gain economic control of the shares. They wanted to buy more shares without being negatively impacted by the price of VW rising. Secondly, because Porsche technically didn't own these shares, the bank did, they didn't have to disclose their buying to the public. Eventually, when Porsche had accumulated 75%, they would just be able to buy them from the bank in one transaction, basically skipping all of the disclosure thresholds. And thirdly, this strategy removed shares from the free float without any of the hedge funds being notified. By late October 2008, this is what hedge funds thought the market for VW shares looked like. 20% owned by the state, 35% owned by Porsche, leaving 45% in free float. The hedge funds were short selling about 12% of the shares, meaning if they all wanted to close out their trades, they'd need to go into the market and buy 12% of the shares. But with 45% in free float, that should be no problem at all. Except Porsche by now had secretly accumulated another 7.5% of the shares directly, and a further 31.5% in those cash-settled options. The free float wasn't 45%, it was 6%. On Sunday the 26th of October, Porsche finally revealed this to the public. Porsche has decided to make this announcement after it became clear there are by far more short positions in the market than expected. The disclosure should give so-called short sellers the opportunity to settle their relevant positions without rush and without facing major risks. That statement is basically Porsche management giving short sellers the middle finger. They knew exactly what this announcement meant. It meant when markets opened the next day, there would be hedge funds scrambling to buy 12% of VW shares to close their trades, when there is at an absolute maximum 6% available to be bought. Markets opened and the price of VW stock skyrocketed, opening 66% higher than the previous close. By the end of the day, the price had surged to 517 euros, a 149% gain in a single trading session. The next day, the panic continued, with the stock reaching 1,005 euros by the middle of the day. That valued the entire Volkswagen company at 296 billion euros, or 420 billion US dollars. I know we're all used to seeing trillion-dollar companies now, but back in 2008, that made it the most valuable company in the entire world. The next day, Porsche decided they'd tortured short sellers enough, announcing they'd release an additional 5% of the shares into the market so shorts could close their trades. The stock finished the day at a price of around 500 euros, and over the following weeks resumed somewhat normal trading. Porsche made sure to point out that the losses for hedge funds were all their own fault. The cost to short sellers was staggering, an estimated 30 billion US dollars. The event was compared by fund managers to a nuclear bomb going off. You might remember the historic GameStop short squeeze back in 2021. Well, that one cost hedge funds $10 billion. So this was 3 times as bad. If a fund had made a 100 million euro short, it cost about 500 million euros to get out of it. That's a 400 million euro loss, a minus 400% return, which is basically what happened to Adolf Merkel. Just a warning, the next part is a pretty serious topic, but I think it's important to mention. Just 2 months after the Volkswagen losses, he sadly took his own life. It's easy to detach these sorts of events as just money or numbers on a screen, but there is a human face to financial events that shouldn't be understated. 26 hedge funds who suffered losses sued Porsche in New York state courts in 2010. They alleged that Porsche had engaged in a fraudulent scheme to corner the market. However, the lawsuit was dismissed because the transactions had occurred entirely in a foreign jurisdiction. So 19 of the 26 funds moved litigation to Germany, seeking 1.2 billion euros in damages. One of the strongest arguments against Porsche was what happened with Max Warburton. Warburton was an investment analyst, and a week before the short squeeze, he published a theory. He believed Porsche was secretly gaining control of more shares by using cash-settled options. It was a speculative theory, but he was 100% correct. Porsche's head of investor relations flat out lied to investors, calling the theory, quote, complete bullshit. But deceptive or not, German courts didn't care. The only issue at hand in their view was whether Porsche was required to disclose the options, and they were not. The suit was dismissed. On the criminal side, both the CEO and CFO of Porsche were charged with market manipulation. But again, they were acquitted in 2016 after the court found no evidence of any wrongdoing. Of course, I wouldn't have made this video if there wasn't an ironic twist at the end. After the short squeeze, Porsche was now ready to take control of Volkswagen. They just needed to convert those cash-settled options into actual voting shares. Well, they didn't have the money, so they accumulated 15 billion euros of debt, including 10 billion euros that had repayments due just a few months later, in March 2009. Porsche assumed that they'd be able to kick the can down the road by refinancing the debt. But as the global financial crisis worsened, credit markets froze up, and banks wouldn't lend anymore. Porsche, which by the way was one of the most profitable auto companies before this takeover attempt, was basically bankrupt. The only reason they survived is because Volkswagen bailed them out by acquiring them. They called it a merger to save Porsche the embarrassment, but it was a bailout. So Porsche, who started 2008 trying to buy Volkswagen, ended 2009 being bought by Volkswagen instead. Absolute cinema. Check out this playlist of my other deep dive videos if you haven't finished eating yet, and thanks for watching.